Hi. The just released Chinese Purchasing Managers Index for the month of January 2015 has come at 49.7, which is a tad below the Flash Purchasing Managers Index. Now, this worsens the problem for China. As you can see, most Asian markets have opened in the red. Now, what is happening in the rest of the world? As I have mentioned many times before, in the short run, there are many negatives which could pull down global stocks, and this is exactly what has indeed transpired. The major reason being that there is a major contradiction between the data about the world economy and the fact that the markets are being driven in a different direction from what the data is suggesting. Let me give you an example. In the United States, for example, the treasury yields have fallen to below 1.7%. This is for the 10-year yield. Oil, which is a very important barometer of industrial activity in the world, is off 60 percentage in value terms just over the last 7 months, and it's very close to 2011 lows highs. This all seems to be indicating that a world slowdown is gathering pace. If you look at Europe, the chances of a recession are deepening. In fact, there is a great talk of deflation taking place in Europe, and that is what has prompted the European Central Bank to unleash its very accommodative monetary policy in the form of quantitative easing. Coming back to the United States, the treasury yields for the 10-year yields have fallen to great lows, and you find oil has also plummeted dramatically. Yet there are a couple of indicators which are positive. For example, the gross domestic product of the United States, although has been low, but it's showing that the American economy is still growing at about 2.4%. There is some growth over there, and don't forget it's one of the largest economies in the world. So this growth rate is indeed translating into higher stock prices, but they have been subdued because of different factors like lower oil prices, like falling yields. At the same time, whereas there are certain contradictions, but do not forget the fact that lower treasury yields also indicates that this is a good time to be in stocks. Another reason is that corporate earnings for America are about $122 for the last quarter of 2014, and although this is much below the analyst expectations, it still is at a record high. This, combined with the fact that a very accommodative policy of most central banks around the world is continuing, shows that the case for stocks is still strong. So, what is the contradiction going to lead us to? I still feel that there will be a weighing of certain negative factors in the short run, which you should look out for. Therefore, this is still not the time to invest, and this is definitely weighing down on global stock markets. But there will be a time when this turn will come, and that would be a tremendous opportunity to enter and enjoy the bull run. Till then, stay calm and stay out of world stock markets. Take care. Bye bye.